Okay, stock and bond market indexes. So we use stock and bond market indexes to kind of gauge average returns of the market as a whole. And we'll talk about a couple different ones in here and how they figure those numbers. We can compare performance of managers, both to the index as well as to other managers. And it's also our basis for derivatives. Our factors in constructing and using an index, we want to know if it's representative or not. We know how broad or narrow it is. And we need to know how it's constructed, how they there's different types of weighting they can do with the index itself. And we'll talk about a couple different ones of those too. So constructing the market index is weighting schemes, the price weighted average. We add the prices and divide by the divisor. And they showed an example. Oops, it didn't in here. I have it in the book. Okay, so the price weighted average. We add the prices together and divide by a divisor. So for example, if I have two stocks, I have stock 1 and stock 2 right here, where I bought stock 1 for $25 and it went up in value to $30, the beginning versus ending, and they didn't give us time frames really, but the stock 2 I bought, or I shouldn't say bought, this is an index. The beginning price for the time frame was $100 and the ending price was $90. So for the whole portfolio, my beginning price, I just add those two numbers together. For the ending price, again, I just add those two numbers together. And I can find a total change and find that my total portfolio change would just be the total change divided by the beginning price. The index, the average, price average index, the way that works, and this is how the Dow Jones works, is they take the total beginning price, they divide by the number of shares. Okay, so they just average it out over, so they get a single number. They do the same thing with the ending price. In this case, I only have 2 shares, so I'm just dividing by 2. Then I can get the average change, and notice that it comes out to the same change, portfolio change, the index comes out to the same change as the portfolio did itself. Okay. The market value weighted index. Market value weighted index is different in that it weights the value of the stocks within the index based on the size and proportion of market value that they are. So, for example, I just looked today, and the current market value of Apple is $2.25 trillion. And they are on the S&P 500, which uses a market value weighted index. Well, they would be weighted substantially higher than 3M, which is also on that, which is also on the S&P 500 index, as their current value that I just checked today was $93 billion. So you're going to have much higher weight on Apple than you will on that. And so Amazon would be closer. Amazon's $1.75 trillion currently in market value. So that would be weighted a lot higher. Boeing, for example, I looked today too, is $97 billion. So 3M and Boeing would be relatively similar in the weight factor that they have, and so would Amazon and Apple would be relatively similar. But Amazon and Apple would hold a lot more weight in a market value weighted index than what the smaller companies like 3M and Boeing would. And an equally rated index is just kind of what it sounds like, where it's a simple average of all the returns. Okay, Dow Jones is a price weighted that we just talked about. Market value, S&P and NASDAQ is a market value weighted, and Value Line Index is an equally weighted index.
Okay. Derivative markets. Derivative markets, kind of like exactly like they sound. Their value derived from somewhere else. So it comes from somewhere else. A derivative asset or contingent claim is a security with a payoff that depends on the price of other securities. Okay, so it's not dependent on the price or what you're purchasing itself, but it's dependent upon other securities. Again, it derives its value from elsewhere. So a call option is the right to buy an asset at a specified price on or before a specific expiration date. And a put option is just the opposite, the right to sell an asset at a specified exercise price on or before a specific expiration date. So you can purchase options. This is what's called purchasing options. And it's the right to either purchase or the right to sell for a given price and there's an expiration time frame. So for example here, for $7.63, you can buy the right, and this is Apple, to buy Apple stock at $135
but you have to do it before May 12th, and this was on April 18th, so less than a month away. It's going to cost you $7.63 per share, and these are usually sold in 100 shares per unit, so $763. Or you can buy a put option, which means you can purchase the right to sell it for $135 for $1.17 per share. So here's a calculation. So call option, the right to buy 100 shares of Apple at the strike price of $135 using the May contract cost is $763. Is this contract in the money? Well, to know that, what we need to do is we need to figure out whether or not it's worth it or not to buy that currently. So if the stock price, I don't think I have this one typed out. The stock price currently is $141.20. We're going to take it times 100 for 100 shares. The value, this is the current value of the Apple stock. 135 is my strike price at 100. It's a call option. So your option says this is your call option. You can purchase for $13,500, but the price of the contract needs to also be added in there. So that is 7.63, again at 100, and that's per share, so at 100 shares. So the total cost of the call option is $13,500 plus 763, which is higher than the $14,120, so it is not in the money right now. Meaning you're going to spend, if you bought it right now and sold it today, you would spend $14,263, but the value of it's only $14,120, so you would lose money on that call option if you bought and sold the call option today. You should buy this contract when the shares of stock go, well, obviously the call option itself will change too, but if the call option stayed the same, you should buy this contract when the price is, well, again, the call option will move when that happens. So when you buy this contract is when those values are different. When you have a higher value for the stock than what you do the cost of the strike price plus the cost of the contract. Put option calculated similarly, where we have the right to buy 100 shares at strike price $135, cost $1.17. This contract, I don't believe, is also in the money, so we got 135 plus $117, so $13,500, so $13,667. But you're selling it for $135, so you're still losing money. You're selling something that is valued at $141 for only $135 at this point. All right, another derivative market is futures. Future contracts, the purchaser buys a specific quantity at a contract expiration for a set price, and the contract seller, short, delivers underlying commodity as a contract expiration for an agreed upon price. This is used a lot. I actually saw this a lot when I used to audit co-ops. It's used a lot in commodities. So even the example they give here, this is a Chicago Mercantile, and it's bushels of, I'm trying to remember what it's bushels of. It doesn't tell me what it's bushels of, but this is bushels of some sort of, I assume some sort of grain or some sort of commodity. And so you effectively say, I want to buy, 10,000 bushels of something for a given price, and I want to have it by, the end of November or whenever that date is. And these we got September, December, March. And so you've guaranteed that price for that given time, and you've paid for the right to do that. All right, and that's it for this chapter.